what you see here is a declining. Right now, there's about 47, 48% of the S&P 500 universe that is trading above its 50-day moving average. Now, the trend here is what matters. It's been declining. You can see this trend has been declining, and that speaks to a deterioration of participation. In other words, underneath the surface, there's stocks starting to falter, even if the indices are making their own all-time highs, again, carried by just a few stocks. So this is quite an unhealthy market. Hello, everybody. It's John Llodra here for the New Harbor Weekly Market Comment Update. Thank you for being with me here today. Purpose of these videos are to bring data, our insight on that data, and really for the purpose of hopefully making this crazy world, this crazy financial world that we all live in, a little bit less crazy and put some peace of mind in our clients and viewers' minds. Want to remind folks to subscribe to our channel by clicking the subscribe button. It's the best way to make sure that you get notified anytime we put new comments out, comments or videos out, and invite you to comment, please. We really want these videos to be helpful and educational for our viewers. So please comment liberally in the comments section. Tell us what you'd like to see. Tell us how we can do better in bringing you content that is most helpful to you. And reach out to us anytime. You can look at our contact info in the bio or the link to this video. Reach out to us anytime. Of course, our clients know that they can call us anytime, but if you're not a client and you're finding this video, we love talking to folks, educating them about the markets, how they apply to their personal situation. And, again, thank you for being here. I'd like you to stick around for the end of the video. I'm going to cover a lot of ground here today. I'm going to try and make it concise. We've had some kind of economic news that have come out in the last couple of weeks on the jobs front, as well as the inflation front. And of course, here I'm recording this video on Thursday, June 13th, 2024. There was the much awaited Fed meeting yesterday. I'll give a rundown of what that meeting was all about, what it means likely for interest rates and inflation and the economy. I do want to talk about the market action. We've registered all-time highs as of yesterday in the S&P 500, and I want to talk about that. Get a bit beneath the surface there, because there's a lot going on there that isn't quite as healthy as it might appear by the headlines. Okay, so yesterday, as I mentioned, was the much-awaited monthly June Fed Reserve rates meeting, where they discuss the economy and their likely path for interest rates, short-term interest rates policies. Let's rewind the tapes a little bit. Last week, we had a jobs report that came in quite a bit stronger on the surface anyways than what the market was expecting. There was a much more significant job creation than the market was expecting. But if you look beneath the surface, the complexion or composition of those jobs was quite, maybe you might even say, unhealthy. There was a very large increase in part-time temporary work and a pretty sizable decrease in full-time work. So the quality of those jobs that beat, relative to expectations was a lot lower than what the headlines might have perceived. The markets last week sold off on that jobs report because, of course, the market was assuming that would mean the Fed would stay hawkish and not drop interest rates. Everything is so key to what the Fed is going to or not going to do. So that was kind of a negative for the markets last week, where good news, quote unquote, good news is bad news and vice versa. This week, the inflation CPI report came out yesterday, Wednesday, the 12th of June, and it came in slightly softer than market expectations. And of course, the first reaction of markets was to almost everything rallied in the pre-market because the perception was that the Fed would take that as a sign they can start to think about more seriously the timing of when they might be able to start rate cuts. I'll get into what actually the Fed said, but suffice it to say, the market didn't keep all that bounce. And the thing I'd like to point out is these month-to-month jobs and inflation reports, they're really kind of noise. It's really the trend over time that matters, and the Fed keeps kind of saying that, even though the market doesn't want to necessarily listen to that. But it's a process here, and it will take probably many months to kind of really get a good read on what's going on here. But so let's go to the Fed meeting, and I'm going to share some charts here to kind of, hopefully in picture form, to summarize what happened there. This is a chart that shows what is called the dot plot of the Federal Reserve Open Market Rates Policy Committee. Each one of these dots, so let me just give a little bit of a tour of this chart. So we've got 2024 here, current year, 2025 here, 2026, and then long term. And what each one of these dots, so the blue ones here are what that's the dot plot, so-called dot plot was at the March meeting, the March 20th of 2024 Fed meeting. And then the white ones are yesterday's Fed meeting, okay? And each dot represents a voting member of the FOMC, Fed Open Market Committee. And basically here on the vertical axis is on the left here is the federal funds rate. Right now we're at a benchmark rate of 5.25 to 5.5. Okay, so if we look at yesterday's meeting, the median forecast of this federal funds rate for 2024 came in right here, which basically shows about a one rate cut of 0.25% for 2024. Okay, if we go back to 2023. The consensus right here, the median was for 3 rate cuts. So yesterday's meeting was a tightening of policy in the sense that the expectations for 2024 by the Fed is that they will only cut once versus their expectations of 3 times as of the March meeting. So that's not necessarily an encouraging development for folks that are salivating at with bated breath, waiting for a Fed rate cut. But there's some interesting data here too. There were 4 members. You see these 4 dots here at the top that don't see any declines for this, any rate drops for this year. So that's interesting. And then there were 7, I think, that assumed 1 drop and 8 that assumed 2. But the median is for 1 drop. If you go out to 2025, you'll see across the board, this is the median forecast for at the March meeting, and this is the median at yesterday's meeting. So across the board, they see higher rates than they did in March. In other words, fewer drops. Now they do see 1 additional drop next year than what they were projecting in March, but still the ultimate rate is higher. Interesting long term here, they've essentially raised what they call the neutral rate, the rate that they think is perfectly in balance with what the economy needs. Of course, we know from history they know not what they're doing in the sense of being that precise, but to humor us anyways, they've raised a neutral rate. So the higher for longer is still a message here. Interestingly, one of the questions in the post-meeting press conference teased out of Jay Powell, the chair, that he thinks that as encouraging as recent inflation reports have been showing modest improvements on inflation, he did acknowledge that there are so-called base effects, year-over-year comparisons that will automatically kind of give upward pressure on future readings. And this is a neat chart that I came across that Carson Investment Research put out. And it basically shows, this is for the PCE, the favored inflation metric by the Fed. And this basically shows, based upon going forward, scenarios of inflation readings, what the inflation projection will be. If we look at the March meeting, there was a 0.3% month-over-month increase. If that were to continue, as you can see right here by the red, this trend in inflation would go up rather sharply, and it would take a very minor 0.15% monthly increase would cause the inflation trend to plateau here. So this picture shows that, in no small part because of base effects, the war on inflation is not over, and the Fed knows it, and that's why they're being so cautious about telegraphing that they're going to drop rates quickly or substantially. Interestingly enough, this has become a really hot button. Obviously, the Fed would love to, or certainly politicians would love to have interest rates drop. There's letters being sent by administration officials and politicians, basically trying to bully the Fed into dropping interest rates. And of course, the Fed is supposed to be politically independent, debatable how much they are. But the reason for that is this is a survey that was done by TransUnion, and it basically shows, what consumers, the surveyed consumers, indicate as their most pressing concerns. And you can see here, inflation and interest rates have risen dramatically in terms of the hot button concerns for folks, even more so than the stock market, for example. People are increasingly worried about jobs. So this is not a good situation from the everyday consumer standpoint, but the Fed knows that inflation is a problem, that cutting rates prematurely could just exacerbate these problems. So it's really a challenging environment here, and the battle's still ongoing here. The victory over inflation has not been won, and I think we'll see this play out pretty dramatically in the months to come. So let's pivot a little bit now to the markets. Yesterday, the stock market, the S&P 500, closed at a record high, first time ever closing above 5,400. Obviously, that's headline worthy. A couple weeks ago, I did a video here talking about how the Dow had closed over 40,000 for the first time. So we're seeing all these headlines about markets can do no wrong. They're all-time highs and no end in sight. And I want to kind of share in a bit here that there's a lot going on underneath the surface here that speaks to the market not being quite as healthy as those headlines might portray. So again, I'm going to share my chart. Interesting, with the close over 5,400, the market has now surpassed essentially every Wall Street analyst's expectations for where the market was going to be in 2024. So you might say that is one measure of exuberance, and I will say that Wall Street analysts tend to be overly rosy in a lot of their things. So the fact that the market has surpassed even all the Wall Street analysts' views is a little bit emblematic of a market that probably has gone ahead of itself. We're not going to try to anticipate that, but it's just very noteworthy that we there's certainly signs of froth abound, and want to raise that caution flag. All right, so this is a graph of all the different, the average analyst, Wall Street analyst target for year end 2024 was 4,861 on the S&P. Again, we closed at over 5,400. So even the most bullish single forecast was only 5,400. So we've greatly surpassed that. This is a chart that really speaks to the underneath the surface and how the market at all-time highs isn't quite as healthy as it might appear. And this chart shows the percentage of the S&P represented by the top 10 companies by size, by market cap. And you can see here over 35% now is composed of just 10 companies. That exceeds even the tippity top of the tech bubble, which was all about the overconcentration of very high, very large mega cap stocks. So of course, this is the Apples, the Nvidias, the Googles, the Metas, the Teslas. A lot of the big story stocks here are what we're talking about here. And this is never a healthy thing. Every major market top is defined by a fewer and fewer kind of high-profile stocks carrying the market, all while the underlying market is eroding. This next chart is another way of looking at this. This shows the 3-month correlation between the S&P 500, which is the SPX, and the equal-weighted S&P 500 index, which is the same 500 companies, just each one given an equal weight rather than a market cap weighting. And you can see for much of this history that goes back to the early 90s, that correlation approaches, not quite 1%, 1-to-1, but very close. But you see in the tech bubble, the correlation, totally broke down because the large cap, few large cap stocks took the cap weighted index way higher. And we're seeing even a more extreme expression of that right now. So really narrow market that is historically not a healthy thing. So of course we can't talk about the market and the upside moves in the market without mentioning the craze of artificial intelligence. This is a great chart that was put together by FactSet, and it shows the number of instances that in corporate earnings calls in the S&P 500 that mention AI in their earnings calls in some way. It's kind of like during the .com bubble. Any company that had .com in their name or mentioned .com, it basically was destined to be a high flyer. Well, look at the surge in mentions of AI here. Just this week, Apple had a huge move higher. I think it was 13% or something like that over a couple of days. Now the largest cap stock in the world. In no small part, I'm quite sure that was due to their rollout or announcement of what they're calling Apple Intelligence, their expression of artificial intelligence. Now, no doubt that AI is real and here to stay. Debatable whether it's on balance a good thing for society, but usually when things get this hypey, it's more hype than actual value. In fact, I forget what earnings call it was recently, but it was a company that's gone big into buying NVIDIA computer chips to power their AI efforts. And the essence of the question that was posed was, are you being able to actually monetize this implementation of AI? In other words, is it translating into real earnings? And the answer was no. In fact, it was quite evident that it wasn't. So it's a big debate still, big question mark as to how much this pursuit of AI applications and things like that will actually translate into value-adding earnings to the company. I think it's gotten way ahead of itself, and I think the share prices of many companies, as a result, have gone up way above where they should be. Underneath the surface of the markets, there's this notion or kind of a aspect of markets that we call breadth. And it's basically a healthy market is where participation is broadly spread across many different stock sizes and sectors and all that kind of thing. This is a chart showing the percentage of stocks in the S&P 500 that are trading above their 50-day moving average. This is just one of many types of breadth and momentum and trend indicators we follow. Other things like bullish percents tell a similar story. But what you see here is a declining. Right now, there's about 48% of the S&P 500 universe that is trading above its 50-day moving average. Now, the trend here is what matters. It's been declining. You can see this trend has been declining, and that speaks to a deterioration of participation. In other words, underneath the surface, there's stocks starting to falter, even if the indices are making their own all-time highs, again, carried by just a few stocks. So this is quite an unhealthy market in that respect. Can go further, of course, and we'll be watching those indicators quite closely, because I think we're at a juncture here where we're either getting ready for the next leg of a significant move higher and what we'll call a blow off top that we think almost certainly will be very temporary and reversed when markets do enter a corrective phase. Or we could be getting really close to what we'll label an exhaustion top, that we may have seen the highs or getting very close to the highs, and this lack of participation, this lack of breadth, will start to carry markets lower. I can't do this video justice without sharing a couple charts of some of the frenzy that's going on. Of course, anybody that has been watching the news or even remotely aware of what's going on is probably aware that the at-home investor that goes by the name Roaring Kitty has been back on the scene. If anybody saw the movie Dumb Money, it's a great humorous movie that chronicles back in 2020 what Roaring Kitty did on the Wall Street Bets Reddit channel to basically create a tizzy in markets. He, basically trumped up the stock GameStop, GME, the ticker GME, and it created all kinds of waves. And he's been back on the scenes in recent weeks, and I'll show a chart there, and you can see what's happened. So this is a monthly chart of GameStop, and each one of these bars shows a monthly move. So this goes back 20 years, I think. See all this period of time in the first part of this century, way down here, and then in 2020 during that Wall Street Bets fiasco, stocks shot up here, and crazy volatility, and over time that petered out. But here's what's happened in just the last couple months. So crazy casino-like atmosphere, and these are the kinds of things that happen at or near bubble tops. I want to show what I mentioned, Apple. Let's look at a chart of Apple. This is a monthly chart of Apple. You can see a huge move here higher in the last couple months. And even on a daily chart, you can see a big move. This is a multi-trillion-dollar company moving like it's a penny stock. Again, in large part because of the hype around their announcement of their Apple Intelligence, their expression of AI. Lots to watch here. It's a fascinating market in some sense. It's a scary market in others. I guess bringing it full circle back to interest rates, ultimately the Fed will drop interest rates, and we think it will likely be when we see some economic and market concerns really start to press, and we're not seeing those quite yet. In fact, there was a question posed in the press conference yesterday, Fed press conference. The gentleman, I think from Bloomberg, asked, if the economy is so strong as you're talking about, and the job market is healthy and this and that, why even talk about any rate cuts? And Chairman Powell basically said, well, we think our what they call their restrictive rate policy will indeed slow the economy and cool off the job market, meaning higher unemployment, that kind of thing. So even the Fed is admitting that there's got to be some notable economic damage before they'll have the leeway to cut. And ultimately, when they cut, it actually may be a bad thing for markets. If you go back, I shared charts on this in the past. If you go back to the tech bubble and the housing bubble, those markets collapsed over 50%, even despite the fact that the Fed was dropping interest rates very, very quickly and swiftly and in large chunks. So better watch what we wish for there in terms of interest rates. Well, that's all I wanted to cover here today. I remind folks to like and subscribe to this video and this channel. Give us your comments and feedback and reach out to us anytime. And I want to thank you for watching. And until next time, I hope you have a great day. Bye for now.